Hello everyone, Chris Isaac of AgDevCo here. I'm sorry I can't be with you in person at the Grow Africa meetings to introduce the subject of working capital finance for smallholder farmers. I wish you a very successful forum. AgDevCo invests patient capital in small and medium-sized agriculture businesses in Africa. We work with companies that are too small to attract private equity but have outgrown microfinance. They typically need long-term investment of between $250,000 and $5 million to expand their farming or agri-processing operations. Our investment is used to install irrigation equipment, to build storage facilities and factories, and to buy machinery. We expect to have to wait 5 to 10 years at least before we see a return on our investments. What we are finding is that all of our investees and many other companies we come across are starved of short-term working capital finance as well. They need finance to invest in their own seasonal production, also to provide inputs to networks of outgrowers, and to buy crops from smallholder farmers for processing. Even for relatively small businesses, those working capital needs can run into the millions of dollars annually. Some banks are lending in this part of the market, but it is high-risk activity, which is reflected by high interest rates. For many small and medium-sized agribusinesses, which do not have a long track record or the ability to provide collateral, there is simply no availability of credit. The lack of finance for SMEs makes it very difficult in turn for smallholder farmers to access loans. The Africa Green Revolution Forum estimates that only 10% of farmers have access to the credit they need to increase their productivity and incomes. The result is a low productivity trap for millions of smallholder farmers. Without credit, there is limited availability of improved seeds and fertilizers. That constrains yields and quality, making it more difficult for smallholders to access formal markets. Low and unpredictable incomes make it difficult for farmers to invest in their land, and without being able to demonstrate a track record of steady income, farmers find it almost impossible to access loans, and the cycle continues. One way of breaking out of the low productivity trap is to link smallholder farmers to formal markets through a trusted aggregator business. The aggregator could be a cooperative or a for-profit SME. Its role is to manage a network of smallholder farmer producers, providing them with finance, inputs, and technical support through an equitable contractual arrangement which guarantees a fair price for the farmer's production at the end of the season. It then stores and/or processes the crop and arranges logistics. The aggregator may be able to negotiate long-term sales agreements with commercial buyers, who might be Grow Africa partner companies, perhaps breweries, food companies, or trading groups. Management must understand the market's requirements on quality and volumes and be able to deliver consistently against those. These aggregator businesses are vital to link farmers to markets. They need long-term patient capital investment, but they also need short-term working capital finance to extend loans to small farmers and to have the ability to buy the crop at the end of the season. A success story is the Eka business in Mozambique, a smallholder farmer commercialization business that started 3 years ago with AgDevCo's support. AgDevCo invested equity to allow Eka to build its collection and storage infrastructure and buy vehicles. Later, AgDevCo financed a Beulah maize mill for on-site processing. Eka management negotiated a 3-year offtake agreement with a local brewery, part of the SAB Miller Group, to sell maize grits for use in Chibuku beer. Eka also sells maize flour and bran for consumption in local markets. Eka provides a full package of finance, agricultural inputs, and extension support to its farmers, who've seen their yields and incomes increase by 3 to 4 times as a result. Last season, Eka purchased maize and soya from more than 4,000 farmers, and this year it plans to buy from over 10,000 farmers. In the first 2 years, Eka had to access short-term working capital from AgDevCo to allow it to buy the smallholder production. Last year, however, after 2 successful seasons, when there had been 100% recovery of smallholder credit, a local commercial bank was willing to lend to buy the crop. This year, ECHA is able to borrow at affordable rates both for the smallholder input finance and for the crop purchases. The lesson of ECHA is that it is possible to build commercially viable and scalable agribusinesses that benefit large numbers of smallholder farmers, but those businesses will not be able to attract commercial finance in the early years before their business models are proven. We believe there is a role for a publicly backed working capital facility to give businesses like ECHA the kickstart they need. Working with Grow Africa partners, AgDevCo is raising a pilot working capital facility of $25 million to allow SMEs and co-ops to work with tens of thousands of smallholder farmers, boosting their productivity and incomes and linking them to profitable markets. The facility needs a mix of commercial loans and grants to enable it to take the risks of lending to early-stage businesses. Grants will act as a first loss cushion, which could absorb foreign exchange losses and other risks. A separate technical assistance fund will make available grants to help establish smallholder farmer outreach schemes like the ECHA model in Mozambique. The facility will focus, but not exclusively, on food crops for local and regional markets. In time, the facility could be increased to $100 million or more, with a target of linking over 1 million farmers to profitable markets. By proving that smallholder farming can be profitable and commercially viable, the working capital facility aims to leverage in a lot more commercial debt and equity into the sector, helping agriculture thrive as a business with benefits for all.